Howdy, folks. Welcome back to Near Sight and Far Sight. My name's Carly Powers, and I will be your host today. So let's talk tariffs. We're gonna dive right in. So, as investors navigate a shifting economic landscape in 2025, one trend is impossible to ignore. The reemergence of tariffs as a powerful force shaping global trade, supply chains, and corporate profitability. So while tariffs are ultimately a tool of economic policy, they have very real and immediate consequences for publicly traded companies, especially those most exposed to global inputs, manufacturing, or end markets. At Insight, we believe it's essential to get ahead of those impacts by quantifying where the risks are most likely to surface. So to that end, our team conducted a sector-by-sector analysis of the S&P 500. We started with the 2024 profit margins of all 11 major equity sectors before any new tariffs were introduced. This baseline gave us a clean pre-distortion read on how profitable each sector was under normal global trade conditions. Some may be vulnerable, others are surprisingly resilient. So let's break it down. So we started with the clean read, pre-tariff profitability of the 11 sectors. Then we layered in tariff exposure. So green for low, yellow for moderate, red for high. This is a simple visual model that shows not just who led in 2024, but who might lead or lag in the tariff-driven world ahead. It's about more than growth or valuation now. It's about margin durability, supply chain agility, and pricing power. So let's talk risk. And we'll start with consumer discretionary. This sector was our first big O moment. High profits, yes, but also high exposure to political risk and tariffs. Think Amazon, Home Depot, Tesla, McDonald's, Booking Holdings, the epicenter of where and how consumers spend their money. So Amazon and Home Depot in particular are caught in the squeeze. They sit between rising import costs and the consumer's willingness to pay higher prices. Either margins get compressed or demand takes a hit, and neither is good. But there is something interesting about that. This sector is already down 11% year to date. It's the worst performing sector in the index. And much of the fear is already priced in. If tariff talks get eased or resolved, consumer discretionary could bounce back really quickly. But we don't want to overlook the stabilizers here. McDonald's and Booking Holdings. They're globally diversified with minimal tariff exposure. McDonald's sources locally. Booking runs a digital first model, so there's no physical goods crossing borders. They add ballast to this sector even as others struggle. Now, let's talk industrials. This is where things look risky at first, but we do want to dig deeper. At Insight, our exposure is concentrated in defense and aerospace, not general manufacturing. So, defense and aerospace companies sell to the US government, often on fixed and cost plus contracts, which means tariff costs get passed to Uncle Sam, to the government, not absorbed by corporate margins. Plus, defense firms often receive carve-outs and exemptions. National security matters, and Washington knows it. We're going to go ahead and shift now to the opportunity side of the ledger, starting with technology. This is the most misunderstood sector in the current market. It's down nearly 10% this year, but the fear is a little overstated. Yes, hardware names like Apple, Nvidia, and Broadcom use global supply chains, but they're not going to be sacrificed. They're national champions, and they've already made big commitments to US manufacturing. These companies have political cover and policy influence. Now, let's look at software. Microsoft, Salesforce, Palantir. No meaningful tariff exposure, high recurring revenue, minimal supply chain risk, and yet they've also been pulled down in the sell-off. For long-term investors, this isn't just a pullback, it's a buying opportunity. Communications is a fascinating hybrid sector. On one side, infrastructure, telcos, internet pipelines, stable, steady, and essential. On the other, Netflix, Google, Meta, the content and platforms driving our digital lives. This sector offers both defense and upside, which is a rare combination. And with only moderate tariff exposure, it can be a solid portfolio anchor with room for growth. So, now what if growth slows further? In that scenario, we want to prioritize resilience. Financials and utilities become essential. Why? Low tariff exposure, lower volatility, attractive dividends. They help preserve capital and still allow us to participate in market upside. When the tide turns, we'll rotate back into sectors that are more aligned with expansion, like technology, industrials, and consumer discretionary. But for now, we stay steady and we stay selective. And we stay positioned for what comes next. So tariffs are no longer a short-term policy blip. They're shaping up to be a structural economic feature for the next year and a half at least. The wise investor in 2025 won't just chase returns. They'll look under the hood to understand where profits come from, how vulnerable they are, and whether that engine can keep running uphill. As always, the goal is not to avoid risk, but to understand it and position your portfolio accordingly. Thank you so much for tuning in today for Near and Far Sight. We've got an article that really dives deep into the nitty-gritty of this. If you want to see more or read it at a deeper level, our understanding of what's going on now and how we are positioning ourselves as a company for our investors. So I hope y'all had a lovely day. And if you want to know more, check out the article, give us a call, and we can talk about it over coffee. Have a great day.